How long can they stay this low? Not for much longer, according to Alan Greenspan, but what are your thoughts?
Well, I think if we talk about the Fed, they're caught between a rock and a hard place. On the one hand, they want to keep the economic expansion going for as long as they can. And so that probably means moderating growth and raising rates incredibly slowly and try to keep rates incredibly low. On the other hand, they do need to raise rates because otherwise, when the next recession comes, as inevitably will, you cannot avoid recession forever.
We haven't beaten boom and bust.
Not yet. I'm afraid no one's found the secret sauce just yet. So in that case, you do need to have higher rates because then, of course, you can drop rates in response to recession, to cut shorter recession and to aid economic recovery. So they do need to raise rates, but our thinking is they will raise rates incredibly slowly at a glacial pace compared with previous cycles.
Talking about how maybe the Fed is sort of stuck in an autopilot. Is that how you see them then? And what breaks them out of this autopilot, do you think?
Not very much, probably. I think if growth were to accelerate more than they think, and of course inflation as a result were to accelerate more than they think, that would present a much bigger problem. But if we just pull back to then look at the data on underemployment, for instance, the U6 rate stands at 9.7%. Now, if we look at the last two recessions, this rate went down as low as 7% and 8%. So we're still a long way. So from that point of view, the Fed could equally well say, well, there's at least 170 basis points lower that we can drag this underemployment rate before wage inflation should become a serious problem. And I think that should guide them and say, well, until we see serious signs of wage inflation and a much tighter labour market, there's no reason to go faster. Remember, the labour participation rate is also at record lows, so they need to get that up. A lot of people aren't even bothering to look for a job today.
So there's still some spare capacity, is
Absolutely,
the message.
Absolutely.
And that's what Janet Yellen has been telling us for some time.
Remember, she's a labour economist by training, by background. So if anyone knows this, she should know this. Upstairs, downstairs, backwards, front. I mean, every which way, she knows the situation.
So she will be homing in on the jobs report due
Absolutely.
out tomorrow. That 172,000 consensus figure is what we'll be looking for. But of course, as you suggested, it's the participation rate and the wages that matter as much as that overall number.
I think so. But as long as you're in somewhere between, let's say, the 150 to 200,000 range, frankly, the number doesn't matter too much. That's the sort of trend they want to see. Not too hot, not too cold. So anywhere in that range will be just fine.
If I look at the work function on the Bloomberg, Edmund, to see what expectations are, the probability of a rate hike, 62% for December, and I look out into next year, and we get into the sort of 70%. I mean, how many Fed hikes do you think we're going to see next year and into the future? I've got dots go here on the Bloomberg. Do you think that the market and the Fed, are they on the same page now? The Fed brought down their expectations of rate hikes a little bit at the last.
I think the Fed's still a little bit optimistic, just as the ECB are very optimistic in Europe on growth. I think the Fed are a little bit optimistic. I think those dot plots will have to come down. Equally well, the market might be a little bit too sanguine. But let's say our median projection somewhere around 25 basis points per year for the next 2 years. So really not very fast. One rate hike in December, one next year, one in 2018.
So how do you invest around that then? We've seen a lot of investors going to what they've called bond proxies, so equity markets that behave a bit like bonds. Do you see that, if from what you're telling me then, not many rate hikes from the Fed, does that trade continue?
I think it's getting a little bit crowded, particularly in the US. If we look at the example of the utility sector, this is a classically bond-sensitive sector. So when bonds go up and bond yields go down, utilities do really well. But utilities have done fantastically well this year, from trough to peak up 20%. Now they're coming off the top because bond yields are actually rising. So I would say that trade has been done, but I would argue there's still plenty of scope in areas such as real assets. I think real estate, even though it's coming off at the moment, I think it's still an excellent place to be, both in the US and more importantly in Europe, in the Eurozone particularly. Secondly, infrastructure. Because I think, as we talked about Germany, the UK as well, with Philip Hammond, there is going to be infrastructure spending. Austerity shackles have been thrown off by Europe, and we need to spend more. And frankly, even in the US, let's be honest, infrastructure is not great. Look at the trains, look at the roads around New York, they're pretty ropey.
So infrastructure is going to be the buzzword maybe in 2017?
I think so. It's going to be a key theme.
I mean, that's the US side of things, and you mentioned infrastructure in both contexts, in the US and Europe. I spoke to, speaking to Fabio just a moment ago, from Fabio Balboni from HSBC, and he was saying we need to, OK, we might see some fiscal spending in Europe next year, but it's by European standards going to be an increase in fiscal spending. Would you go along with that? I mean, you sound as if you're quite gung-ho for infrastructure spend.
Well, I think I think there's plenty of scope, and I think if we take the German example, Germany are running a budget surplus. Obviously, Angela Merkel stands for re-election in autumn next year, so there is a political imperative. And thirdly, of course, the interest cost to the German government of borrowing money has come down dramatically. In 2012, 22 billion euros a year was spent on interest costs. Now it's 14. With its German bond yield at 0, in 9 years that could be nothing. So the ECB is saving the money by dragging bond yields down and keeping them low, and they should be able to use that money for infrastructure spending. There's no reason why not.